Good morning, everybody, and welcome to our post-budget summary. My name's Phil, and welcome along for today's post-budget announcements and comments from ourselves. So just a bit of housekeeping. If you're unable to hear me, as surprising as that can be, sorry, there we go. Then you can log in via telephone, so 020-3713-5012, or use the access code and the webinar ID on screen as well. As just happened then, apologise for any technology issues as we go along with this. We should all be used to this by now, but I managed to click a button that I shouldn't have done. A bit about myself. I'm one of the Director of Taxes at Mitchell Charlesworth, with a bit more of a specific focus on corporate tax, but cover a wide range of tax issues for our clients on tax planning, and have a particular focus on research and development tax relief as well. By all means, feel free to ask any questions during the webinar via the chat function, and I'll look to try and answer those as best as I can at the webinar. Or if you feel more comfortable, contact me straight after the webinar. My email address is on screen at the minute, and it'll be on screen at the end as well. This session is being recorded, and it will be circulated along with the slides following the webinar. So the agenda for today. Yesterday there wasn't a lot of tax announcements made, but there was a few, and there was a few announced in the last budget as well. So the first part is going to be all about what we already knew heading into the budget speech. So we've got the change in the corporation tax rate, a bit about loss relief, a bit about the super deduction and the freeze on the tax thresholds. And then we talk about the new tax reliefs and tax changes that have been announced. So particular focus on the health and social care levy, the annual investment allowance element and how that could be linked to future spend and plans around future spend. The business rates review, so a bit of the announcements made, but also how that will impact long-term thinking. A bit of the announcements on R&D in the creative industries, tax reliefs, and the future changes being possibly proposed for R&D. That could be quite interesting for quite a few people here today. And then just a bit of a broad brush on the other announcements announced that could and could not impact ourselves. And then finally, what I want to just do a little bit of a focus on is how the impacts of the health and social care levy and the corporation tax increase can have an impact on remuneration planning in the future, and how that could actually impact what we end up with net in our pockets in the future. And then a little bit of a summary for myself. So what we already know. So back in March, Chancellor announced that the rate was going to increase to 25% for corporation tax from the 1st of April 2023 for profits over £250,000. And that was reaffirmed again in the budget yesterday. He specifically mentioned it in his speech that the rate will go to 25% from the 1st of April 2023. Profits under 50,000 and under will be subject to 19% corporation tax rate, and then a marginal rate of corporation tax between 50,000 and 250,000. Back to the good old days where we had to do marginal rate calculations. We're moving as well from what we call 51% group companies to associated companies rules, and this mainly impacts the thresholds. So, for example, that £250,000 threshold would be reduced if you've got associated companies or companies part of a group, and it will also reduce the thresholds for quarterly instalment payments. At the minute, that's £1.5 million. That threshold is reduced if you have a group structure in place with trading entities within that. That will shift to associated companies. So if you've got companies outside of the group, they form part of that threshold calculation, meaning that from a cash flow perspective, corporation tax could become due sooner rather than later. Closely held investment companies, such as family investment companies, they will be taxed at 25% regardless of profits. There's no lower rate or marginal rate to be considered. And as I just mentioned there and mentioned earlier on, this will have a knock-on effect for salary and dividend remuneration planning. And I'll provide a bit more information on that towards the end of this session. Loss relief carryback extension, again, announced in March, extended from 1 year to 3 years. For corporation tax, that applies to periods ending between the 1st of April 2020 and the 31st of March 2022. So there may well have been periods already prepared and already looked at where actually there could be a corporation tax refund due to the company. However, as we move closer now towards that end point, what we need to start thinking about is actually, is it beneficial to carry it back? Do we need the cash? If we need the cash, yes, let's carry it back because we need that money coming through the door. But if cash flow isn't tight or isn't a necessity at this stage, you may want to start considering carrying forward the losses instead. And with a view to a 25% rate from the 1st of April 2023, you'll get more benefit for those losses if they can be offset against profits arising after March 2023. If you think you're going to use all the losses before then, you're probably better to carry back and get the benefit much sooner rather than later. But it's something to consider and talk to ourselves about to make sure we're making the right decisions moving forward. For income tax is a bit simpler. It just applies to the 2020-21 year end and the 21-22 year end, tax years even. And it's just restricted to trading income only. So it doesn't account for property income or dividend income or any other sort of income other than trading income. The super deduction, this was the big announcement from the last budget, and it was mentioned again as a way of trying to drive investment in this current budget. It's a capital allowance in effect, but a tax relief for companies spend on new and unused plant and machinery. So since the last webinar that we did on the budget, we've got a lot more information on what this entails now and what is and is not allowed. The 130% deduction is available to spend on new and unused plant and machinery between the 1st of April 2021 and the 31st of March 2023. There's a 50% deduction for spend on similar items that would go into the special rate pool, so it mainly focused around integral features there. Only available to companies, it's not available to sole traders. They will continue to receive the annual investment allowance. And this is really important when thinking about future capital investment. And if you're going to spend a significant amount of money potentially on new machinery or new software or new systems or new office setting, furniture, etc. Thinking about doing that spend sooner rather than later to benefit from a higher tax rate could be beneficial and could also fall in line with what they announced on the annual investment allowance yesterday, which I'll move on to shortly. We've got the freeze of tax thresholds, and this is becoming more and more evident now of what we call in the profession as a stealth tax. So we've got the income tax personal allowance that's been frozen at £12,570 up until April 2026, and the high rate band also being frozen at £50,270 for the same period. The IHT threshold and the annual exemption for capital gains tax will also be frozen for the same period. The VAT registration deregistration thresholds are frozen from the 1st of April 2022 for 2 years, and the pension lifetime allowance frozen at 1.073 million until April 2026. Why we call it a stealth tax is that actually, as announced in the budget yesterday, wages have grown 3.5% since February 2020. And we're all aware that property prices have increased, and they're forecasting that property prices could increase on average by 13% over the next 12 months. So what we're seeing now is that more people and more workers and more shareholders and dividends and owner businesses are becoming to pay more tax. They will end up paying more as they go over the high rate band. Or in certain instances, low earning workers will start to pay tax because the personal allowance is staying at the same level. And people will be paying more inheritance tax. As a report came out today that there'll be more and more people paying inheritance tax over the next 5 years because of the increase in value of assets. As the thresholds stay the same, but the values of the assets increase, more and more will be in the remit of inheritance tax. So it's really quite important, particularly from an inheritance tax point of view, to start potentially having to think about your plans in the future. I know we've spoken to quite a few clients recently who have cottoned on to this potential issue and are starting to think of longer term plans to ensure that what they pass on to their relatives in the future isn't got a significant tax implication with it. And just a little bit here about the coronavirus measures and how they are starting to be retracted and not being used now. So the coronavirus job retention scheme, and that ended on the 30th of September 2021. No indication that's coming back, even under a Plan B scenario. That seems to have now finished. Stamp duty threshold on residential property, that's now reduced back to its pre-COVID levels of 125,000. So we were at 500,000 up until the 30th of June. We then went to 250,000 up to the 30th of September, and now we're back at the 125,000 rate, a level even that we had pre-COVID. We've got the reduced rate of VAT for hospitality, holiday accommodation and attractions. That's now at 12.5% from the 1st of October 2021 through to the 31st of March 2022. That's increased from the 5% level that we had before then. We've got the recovery loan scheme, which has announced that this has now been extended until the 30th of June 2022, and there's some additional changes to be implemented from the 1st of January 2022 as well. So if you're relying on that scheme to get some finance into your business, worth having a look and seeing a bit more about those details announced yesterday. So what was announced in the budget yesterday? Well, Rishi went on a bit of a spending spree. And what many of the analysis are saying is that that spending spree has been allowed through the higher than forecast growth that we've achieved. So we're forecasting 4% growth, and we're now upward forecast of 6.5% growth. And also from the tax rises that we've just mentioned there. Given the wages have increased, given that he knows he's going to get more through corporation tax in the future, he's been able to rely on those tax reliefs and tax increases to fund future spend, as was announced yesterday. But from a tax point of view, the biggest announcement that occurred before the budget was the Health and Social Care Levy. This was announced in September, and initially it's going to be an increase in national insurance contributions and dividend tax rates across the board from April 2022. So the rate of Class 1 employees and employers national insurance and Class 4 national insurance are going to increase by 1.25%. So for employees, the threshold, the rates will increase from 12% to 13.25% and 2% to 3.25%. For employers, it's quite a significant increase now. You're going from 13.8% to 15.05% rate for employers. And for Class 4 national insurance, also increasing by 1.25%. From April 2023, the levy will be shown as a separate item on the payslip. Still staying at 1.25%, and as far as we're aware, still relying on the NI thresholds for when it would then become due. What was announced in the detail yesterday was that the national insurance thresholds are also increasing from April 2022 in line with inflation. So it's a 3.1% increase on the threshold. So for employees and Class 4 national insurance, you now have to earn £9,880 before you pay any national insurance. For employers, national insurance, it's £9,100 per employee before you have to pay any employer's national insurance. And the dividend tax rates are increasing by 1.25% to some unreasonable rates of percentages that we'll have to remember in the future. So the basic rate band will go to will go from 7.5 to 8.75. The higher rate band will go from 32.5% to 33.75%. And the additional rate band will go from 38.1% to 39.35%. And also the Section 455 tax rate will increase from 32.5% to 33.75% at the same time as well, in line with dividend tax rates. So it's expected to generate £12 billion a year, the levy. It's a significant increase, and it will hit the pockets of everybody going forwards. In the budget yesterday, he announced about the annual investment allowance. So we were meant to reduce the annual investment allowance from £1 million that we currently start at to £200,000 per year from the 1st of January 2022. He has confirmed in the budget, all to do with investment and growth, that actually AIO will be maintained at the same level of £1 million until the 31st of March 2023. In my opinion, that's good news. It just gives businesses and the ability to know what they can and can't have for quite a prolonged period now, and are able to make solid business decisions on how much tax relief they can potentially return on any capital investments being made. The date is significant in my view, 31st of March 2023, because that coincides with the end of the super deduction. And it also coincides with the beginning of the increased corporation tax rate. So for me, it begs the question, what's going to come next post 31st of March 2023? providing a big tax relief in the super deduction. It's going to cost the government a lot of money, is the super deduction tax rate. Annual investment allowance is also costing the government a lot of money. So are they going to possibly think, well, from the 1st of April 2023, actually, we're going to strip this back and you're not going to get as much relief. And therefore, that then begs the question that if commercially viable and you're planning on a big spend in the coming periods, may be worth considering doing it now rather than later and benefit from maximising as much tax relief as possible from capital allowances. Business rates, the biggest talking point before the budget and probably after the budget as well, in that a lot of people were hoping that business rates would be scrapped or significantly reformed. But as Rishi Sunak said in the speech yesterday, it raises £25 billion per year for the government. They're not going to just suddenly scrap it without having something significant to replace it. And it's not something that they can afford to scrap at the moment either, given that they need to raise funds to recover from the pandemic. So for me, it's clear it's not going to be scrapped. And it's clear that they've almost put it in a box and said this is too hard to reform at this stage. We'll leave that for a later date. However, in the budget, there was reliefs, as they're calling it, worth £7 billion that were announced. So these included a temporary relief for eligible retail, hospitality and leisure businesses in England to receive 50% relief up to a cash cap of £110,000 per business for the next tax year. I think that's really important. For me, I wrote a piece recently about how I felt the health and social care levy, although brought in with the right motives in mind, really decimated businesses in this area. They were not going to be able to cope potentially with recovering from a pandemic where they've hardly traded, to now having to pay more to employ individuals. So I think this change is a really beneficial one for those areas of our economy. The multiplier for determining businesses was meant to increase in the next tax year, the 2022-23 tax year, but this has now been cancelled. Another positive step in my opinion. We've also got a couple of different reliefs for improvement and again, spending, investing in your business and your property. So we've got 100% improvement relief that are going to be introduced in 2023, which provide 12 months relief from higher bills for occupiers where eligible improvements to an existing property increase the rateable value. So you can rest assured in planning a potential big project that actually your rates, you've got a bit of relief on before the increased rates value will come into play, and therefore you can try and maximise the position before then. We've also got 100% relief that will be provided for eligible low carbon heat networks, so green technology, as Rishi Sunak called it in the budget speech yesterday, that also have their own rates bill. So I think there's an issue coming up where you have a solar panel system that actually resulted in a rates bill in its own right, which was deemed unfair when you're trying to become more green and help the environment. So a relief coming in there as well. For me, in particular, the interesting developments yesterday was focused around the R&D and the creative industries tax reliefs. Both corporation tax reliefs for people that don't know, both that can be really beneficial to companies that are undertaking certain activities or operating in certain sectors of our economy. From an R&D point of view, they're going to modernise the tax relief, as Rishi Sunak called it yesterday, to allow for data and cloud costs to be included in the claim. Positive step, in my opinion, moving with the times for how businesses now operate. What was more interesting, though, was the refocusing of the R&D relief to innovation occurring in the UK. So some of the facts and figures that Rishi Sunak was discussing yesterday was that actually the R&D tax relief costs the UK £46 billion in the year. In the last year, this was announced in statistics that were released at the end of September. But investment in the UK, it was only £26 billion. So there's a big gap there from a government point of view to say we are funding R&D activities that are actually occurring outside of the UK. And now that we have left the EU, we have the ability to change that position and adopt more of a model than Australia, who really focus on their developments in Australia. I think that would be really important in the future, particularly for some of the bigger companies that operate in this country, because they won't be able to necessarily benefit if the R&D is taking place outside of the UK. And at this stage, we're still waiting for more detail on that. So the information released yesterday was we are going to introduce this in our next finance bill with an aim for rollout in April 2023. So we might get some information next month when we have something called Legislation Day in the tax world, or it might be this time next year that we actually hear first what's going to happen. I'll update further once we know. A disappointing element for me yesterday was that actually they were going to miss a target that was quite crucial to the government. They pledged to hit £22 billion spend on R&D by 2025, and they're having to delay that for two years to 2027. I think that's disappointing for business and disappointing for business investment. I think that could prove a bit of an obstacle for obtaining outside UK investment into the country. But they're still going to be spending 20 billion by 2025, so it's not as bad as it could be, but it was a big target that they hoped to reach by 2025, and pandemic and other elements have meant that that's not going to be possible. From a creative industries tax relief point of view, yesterday was a very good day for businesses and companies that operate in this area. So we were going to have a point 31st of March 2022 where museum and galleries tax relief, which provides cash back to museums and galleries in this instance that operate and are putting on events and museum and galleries and etc. That provides them with cash back and can provide with money back to fund future events and future showings in the museums and the galleries. And that's now been extended for 2 years to 31st of March 2024. But also the rate of relief for theatres, for orchestras, for museums, for galleries and exhibitions has increased. It's actually doubling from as of yesterday. So the rate of relief was 20–25% for some of these types of reliefs, depending on certain circumstances. Been upgraded to 40 and 50% in certain instances to the 31st of March 2023. And then it's tapering down again in 23–24 and returning back to normal levels in 2024–25. That's really important for this area of culture, whereby they've been hit really hard from the pandemic and wanting people to be more culturally aware and get back into going to museums and the theatre. To provide that funding through this tax relief, I feel is really important, and it's something for the businesses in this area to really consider. And by all means, get in touch if you've got any questions about these reliefs. More than happy to try and help as much as we can. Just some other announcements that were made in his speech and through the information provided post-budget. National living wage is going to increase to £9.50 per hour from April 2022. Fortunately, obviously another cost to business, helping low earners though generate more income for themselves. I think Rishi Sunak said that there's for full-time work on the national living wage, it's a £1,000 a year increase. So it's a significant increase to them. It comes with its significant cost to businesses as well. Obviously, with the 15% employers' national insurance rate now, that's a significant cost to businesses to factor in as well. National minimum wage is going to increase as well, but we don't know what that is yet. We'll get that announced in due course. Something that was snuck in, mentioned in the press beforehand, not mentioned in his speech, but snuck in with the detail that was released afterwards, was the minimum pension age is going to increase to 57 from the 1st of April 2028 from 55. So what that therefore means that you can't access your pension for an additional 2 years from the 1st of April 2028 without incurring some significant unauthorized payments, tax charges against the pension scheme. So delaying people being able to retire early in that instance is a shame. But I think as the nation continues to grow and live longer, it seems to be a sensible move in my opinion. Widespread reform to the alcohol's duties regime. I'm not going to go through the detail, but you'll be pleased to know that the price of a pint and homegrown sparkling wine will decrease, but your red wine lovers, you're going to have a slight increase as a result of these changes. We've got a reform of the tonnage tax regime and of domestic air passenger duty. That along with the alcohol duties regime is they're saying is as a result of being able to leave the EU, we can change these and change how we deal with these sorts of taxes and duties. More information to be announced. We can provide that in due course. We've got a new tax introduced, which is a 4% residential property developers tax to be implemented on companies with profits over £25 million in this area. This is to fund cladding and the removal of unsafe cladding. And so it's a specific tax rate to assist with a very significant problem, as we saw with the Grenfell tragedy in 2017. Not going to impact many businesses other than your big home builders, but something to be aware of. The banking surcharge got a lot of press before, and from the Labour opposition speeches, in that they were providing a tax break for banks, and actually they're not really providing a tax break for banks. So we've got a situation at the minute where they have an 8% surcharge for corporation tax on their profits made through banking. So instead of paying 19%, they actually paid 27%. He's actually reducing the surcharge from 8% to 3%. When the corporation tax rate increases to 25%. So actually the overall rate for banks is going to increase by 1% to 28%. I think it's something that had to be done, because if they didn't and kept it 8%, we're talking a 33% corporation tax rate on banking activities. And given that London in particular is a hub for banking and finance, that could be a real big detractor from keeping these sorts of industries and sectors in the UK. Last but not least, we've got a position at the minute for capital gains tax where you dispose of a residential property, you have to file forms and make payment within 30 days of that disposal. Now that's been increased to 60 days. I know from our perspective, we've had many an issue with HMRC trying to meet that 30-day deadline, because you've got to jump through hoops to be able to register to prepare the form. So we're now at 60 days instead, which seems more sensible for me. And here I just want to talk, as I said earlier, a bit about how the impacts of the Health and Social Care Levy and the corporation tax increase, how that impacts remuneration planning. And a little bit of a background. When we've been dealing with clients, and you've got your owner managed businesses who are the directors and the shareholders, and as has been the case for many years, they will take a small salary that takes them up to the employer's national insurance threshold, and then the rest is a dividend. And that provides these individuals with a significant enhanced net income and a lower tax liability as a result. And the basis for those calculations is, well, how much would it cost if you were to have a salary of, for example, 50,000, 75,000, 100,000? How much would that cost the company? And at the same cost, what salary dividends are we going to take, and what's our net income thereafter? So the table's just got a couple examples of the results here. So currently, somebody on a £50,000 salary is receiving a net income of £37,662 for the year. On a salary and dividend model, they're actually receiving a net income of £44,364. So it's a significant amount extra income. 75,000, they're around 52,000 compared to 60,000, and 100,000 is 66,000 compared to 76,000. So significant differences, legitimate differences, legitimate planning, and allowed under the tax regime. From 2022-23, we've got the Health and Social Care Levy. So actually for salary workers, the impact of the Health and Social Care Levy is more significant than for salary and dividend taxpayers, because we're keeping the same tax, keeping the same cost to the company. So actually there's a drop of about £500 for £50,000. There's a drop of about £750 for 75,000, and 100,000 dropping by more than £1,100. For dividends, it's not as significant. And that's because of the increase that they've just done in the thresholds for NI, and also for the fact that you are keeping the cost the same regardless of the cost of the company the same is reflected throughout. So we've got salary and dividends. Actually, if you're earning 50,000, you've got a very small increase. For 75,000, you're losing about £200 in the year, and 100,000, you're losing about £300 in the year. The big impact comes when we have the increase in corporation tax rate. So as I said earlier, the basis for our calculation is that we're going to have the same cost to the company if they were to give us a salary as opposed to a salary and a dividends. My apologies, there we go. So same cost throughout, regardless. And therefore, because the companies will actually get a higher tax relief on the cost for the salary and get no tax relief on the cost of the dividends, this in effect increases or decreases, sorry, the cost of the company, and therefore decreases the amount of dividend that would be payable under this model. So, for example, in 22-23, a £50,000 salary level split between salary and dividends, it's going to give us £44,388 of net income. That reduces by 1,500 quid to about 1,800. For 75,000, we've got a reduction of about £3,000 there. And then for 100,000, we've got a reduction of about £4,000. So if you were to maintain your level of salary as the same, or you would maintain the same cost of the company, your income is going to decrease. If you maintain the same level of income, regardless of the cost of the company, then actually the cost is going to increase to the company or providing you with that income, and therefore the net benefit will reduce in the same way. But that's really important to be considering and discussing with ourselves and your advisors, because ultimately you've got to think, well, is it going to be beneficial for me to take more dividends sooner to benefit from a lower rate and to not cost the company as much potentially in the future? Is it, or am I actually going to increase my package once those higher rates of tax come in, and can the company afford that package? Can we afford to make that happen given the current times as well? So just something I really wanted to demonstrate today is that the impact that both of these, the levy and the corporation tax increase, are going to have, and something that is to be considered probably sooner rather than later and discussed with ourselves. So a bit of a summary. Again, lack of announcements on changes to capital gains tax, and what was entrepreneurs relief, now known as business asset disposal relief, inheritance tax, and no immediate tax rises. Obviously, the health and social care levy coming in from April 2022. Again, wasn't as sweeping on tax reform as many feared. And my opinion now is I don't think it's going to be in the future. I think we're obviously at the highest tax net rates since the 60s. And I don't think as a Conservative government they want to provide any more additional tax rates and higher tax rates. So I think my personal opinion is in capital gains tax, inheritance tax, I think that they're going to leave alone. I don't think they're going to touch it, which is good news for some of the people on this seminar today. They spent significantly, the government yesterday, on the back of higher than forecast growth from 4% to 6.5%. However, there was a few bits in there that we've really got to be careful of and be thinking about. And it's made it quite clear in the budget we're not out the woods of the pandemic yet, and slotted in the fact that we're going to have an average 4% inflation rate, which contradicted what the Prime Minister said at the party conference a month earlier. So inflation actually going to increase and get worse before it gets better. So big cause for concern for many businesses there, and for many families as well. I personally think the changes announced on R&D tax relief yesterday are going to be significant. They're going to be fascinating to understand what they're going to try to do, and it could really impact the ability to claim R&D tax relief in the UK in the future. Watch this space on that one, and I'll provide more updates on this as and when we know more detail. Finally, he ended the speech to confirm that he's a full-on Thatcherite, that he does not like having high taxes and would like to reduce them in the future. Bit of a wishy-washy statement, that, in my opinion, because he didn't really provide any background to that. So that will be interesting to see how he's going to achieve that in the future. And last but not least, just a save the date here. We're hosting an IR35 seminar in Liverpool City Centre on Tuesday, 23rd of November 2021, alongside DTM Legal. It says there the bacon sandwiches on me. They're definitely not on me, but there will be bacon sandwiches supplied at the event. It'd be great for anybody interested in this area to come along, and invites will be sent out shortly. So that's everything I've got to discuss today. I'm just going to see if there's any questions that have come through. So first question is, will the additional 1.25% on employers NI remain from April 2023? I think it will, but I know they've said they're going to keep this as a very much a separate thing on the payslip, and it will be called Health and Social Care Levy. I think that you are going to keep it on employers' national insurance, and actually that from anybody working over the age of state pension would have to pay the levy as well post April 2023. So it seems to make sense that they're keeping it on the employers' NI as well. Not what we like to hear, obviously, but unfortunately, it's a means to an end. It's a sensible thing to try and get pay and help with social care in the NHS without a shadow of a doubt. Just another hit to businesses there, unfortunately. What is defined as an eligible RHL business to be eligible for a 50% reduction? The actual information has not, so RHL there, sorry, is Retail, Hospitality and Leisure. The detail hasn't been announced yet, unfortunately. As and when we know what that definition is, we will we'll provide that, we'll issue that as a bit of a press piece and let you know. Unfortunately, I can't provide much more information on that at this stage. Is there any protection from the minimum pension age? I thought the consultation paper suggested that for people who had already started a pension would have their 55 age access protected. Again, not a lot of information provided in yesterday's announcement, just that they were going to legislate it to be 57 from the 1st of April 2028. So I think if you are 55 before then and you access it, I think it will be protected. If you haven't accessed it after then I think, but you're 55 before the 1st of April 2028, again, I think you'd be protected. It's after the 1st of April 28 they're going to feel the hit of that, I would assume. Another question just come in. Will only UK R&D apply to staff who work abroad but are on UK contracts? Good question. I think it's that you're going to have the innovation in the UK. So that would be people working in the UK from a facility possibly in the UK. I think if you're outsourcing it to third parties overseas, there may become an issue. At this stage, it's very much hearsay. We haven't had any detail provided, and we're not going to have any detail provided for a little while. But the gut feeling is, based on the Australia model, my understanding of the Australia model, as limited as it is that actually it is having to be incurred in Australia. The innovation has to be in Australia rather than somewhere else. So if we're going to follow a similar model, then it would suggest that the R&D staff would have to be in the UK rather than just on contracts in the UK, because they wouldn't still not be paying any tax in the UK because they'd be classed as non-resident. Another question there. What's the difference of business rate for R&D company? So I think you mean there, what's the corporation tax difference? Because business rates is something different, but from the corporation tax you get an additional relief. So for an SME, that could be up to 33.35p in the pound on R&D spend. For a large company, it's an additional roughly 11p in the pound in additional tax free. So it's quite beneficial, and you've got to be undertaking certain activities to qualify, but it's something to be considering as a business to understand what the relief potentially is. And have that discussion with a person like myself. I'm more than happy to have a no obligation conversation about your business and if you are conducting any activities in that area, so that you're aware that also, if you're not now, but for future reference, if you're doing something, you might go, might qualify, and therefore we can have a look at that and see if we can help you and help you with the claim. So I think that is it from ourselves. Just a bit of a disclaimer there at the end. Thank you very much for attending today. I hope you found the session useful. As we said, by all means, please get in touch if you have any questions. Contact me directly if you wish. I hope to speak to you and see you all soon. Thank you very much.